Welcome, everyone, and thank you for attending the latest installment of our Macroeconomic Expert Insight webinar series. I'm Oliver Dancel-Fisher, Head of Economic Content for our data stream platform at Refinitiv, and I'm very pleased to have you join us today. Now, just before we kick off, I'll be running over some housekeeping items before introducing our speaker. So there's no dial-in for this audio, so please make sure you use your device's sound and plug in your headphones to listen to the webinar. To ask questions, on the left side of the audience console is a Q&A chat box. Please submit your questions in this box. Our presenter will try to answer as many questions as they can during the last 10 minutes of the webcast, but if a fuller answer is needed or if we run out of time, it will be answered later by email. And we do capture all questions. Just in case you have any technical issues during the webinar, first try refreshing your page. If that's still not working, please comment in the Q&A box. We do have an online technician monitoring today's webinar. A link to the recorded webcast, a copy of the slides, and other resources we will email to you after the conclusion of the event. You may also access the webcast on demand using the same audience link that you used today. So I'll now turn you over to Steven Ricchiuto, who's the Managing Director and Chief Economist of Mizuho Securities USA for today's presentation. Steven, over to you.
Thank you very, very much, Oliver, and thank you very much, everybody, for dialing in today. I was presented with a topic which was basically to explain why some business cycles are uneven and some business cycles tend to be less uneven than we've been seeing recently. And this drives home the point directly to the current business cycle, because the current business cycle is a unique business cycle, because we've seen this very, very rapid decline in fundamental economic activity in the second quarter. And if you look at the nowcasters produced by institutions like the Federal Reserve Bank of Atlanta, the New York Federal Reserve, they're all indicating that we are going to see a very, very powerful rebound in economic activity in the third quarter. In fact, some of the nowcaster estimates are implying that the economy will bounce back by as much, if not a little bit more, than it actually consolidated in the second quarter of the year. Yet when we look at the financial press and we look at obvious things we know, like the impact that this business cycle has had on the leisure industry, in particular restaurants, in particular to hotels, in particular to movie theaters, airlines, and things of that nature, we sit here and ask ourselves a question: how could the economy have bounced back so aggressively if we're looking at an economy that has been hit by such a large major macroeconomic shock? And the answer to this question is very, very important, because it gets to a definitive difference between business cycles in the post-1990 period and business cycles prior to 1990 in the post-war period. And this is really what I'd like us to talk about today. And I will drive the point home into how this cycle stands very, very, very different from other cycles, but how the concept of what has happened or evolved in the economy since 1990 has made this cycle very, very unique. And the answer we're going to get to is basically that in the post-war period, there's really two classifications of business cycles. There are those business cycles that happened prior to 1990 and those business cycles from 1990 forward. And if you just look at the slide that I've put up there right now, which shows the year-over-year growth rate in inflation in the United States as measured by the CPI, you can say there's a big, big difference in terms of the way inflation was behaving in the early portion of the post-war period and the way inflation has behaved in that post-1990 period. And we're going to get to the understanding as to what has changed. And what has really changed is I am defining a difference between what I call inflation cycles and what I call credit cycles. The period prior to 1990 was really dominated by inflation cycles. These were dominated in an environment where the world lived in a period of excess demand following the war. That excess demand created an environment where resource utilization was quickly pushed to its limits in a business cycle upturn. And because resource utilization was quickly pushed to its limits, you saw an environment in which inflation tended to rise cyclically and tended to decline cyclically. And the component that created the difference between the rising and declining period was the Federal Reserve. The Federal Reserve got in the middle of these inflation accelerations, put its foot on the brakes, and the net result is as the economy slowed, inflation came off the boil. As inflation came off the boil, as the economy slowed, as unemployment rates went up, eventually there was social pressure on the Federal Reserve to ease up on its restrictiveness in terms of monetary policy. And the net result is in a world of excess demand, once the Fed took its foot off the brakes, the economy came roaring back, and we went from one inflation cycle to the next. And these inflation cycles tended to build on themselves, as you can see from the chart that we have identified right now on your screens. They've built on themselves because in this period as well, we were also changing the social contract that the government had with its constituency. We went through the period of the Lyndon Johnson Great Society experiment, the expansion of Social Security, the cost of living adjustments to Social Security, the addition of Medicare and Medicaid to the U.S. fundamental framework for support for families, especially in retirement or for families of underprivileged households. All these factors added to the cost structures. And the result was inflation was on an upward acceleration. It reached a point in the late 1970s where this spike in inflation became so politically untenable that the Federal Reserve launched on a very, very aggressive tightening in monetary policy. And Paul Volcker moved us in October 1979 from basically Keynesian economics to monetarist economic policies driving the Federal Reserve. And the net result was a dramatic rise in short-term interest rates. In fact, at one point in 1980, the Federal Reserve conducted a tightening operation on a daily basis, and the short-term overnight federal funds rate gapped all the way up to 26% in one trading session. That type of high level of interest rates caused a dramatic squeezing in the economy, and it squeezed out inflationary pressures in the economy. And most economists would draw a line there and sit there and say, if you look at that second reshading where you see the two recessions very close together in the 1980-1981 period, they would draw a line right in there and say, this is the break. When the Fed transited to monetary policy driven by monetarism versus Keynesianism, the Fed broke the back of inflation. I'm going to add to that by saying other factors came into play. It's not just that we broke the back of inflation expectations due to very, very high interest rates and a transition from a questionable monetary policy in terms of its commitment to containing inflation to a commitment to contain inflation. What actually occurred in here was also the Ronald Reagan supply-side economic environment. And this is very, very critical. Not that the supply-side tax cut worked. It didn't. But what actually occurred as a result of the shift from supply-side demand-side economics to supply-side economics was we transited from a retirement system dedicated to defined benefits to a process of defined contributions. This then changed the investment psychology in the U.S. economy. When individuals suddenly became responsible for their own retirement value, their own retirement health, they then began to demand double-digit returns. Because when you look at the contributions that individuals are allowed to make to their 401ks and that companies will match to their 401ks, and you try to calculate from that how much money you're actually going to need to retire, the only way to make that equation solve where people will be able to afford to retire in that period, 30 plus years, 40 plus years out, is if you have double-digit returns. Double-digit returns, then the demand for double-digit returns then transited immediately into corporate America having to shift its focus. Corporate America had to go from being bloated and over bureaucracy and excess employment to becoming mean and lean. And this is exactly what happened in the early stages of the 1980s. As we began to see this inflation still rising, underlying the system, we began to see this transition to a meaner and leaner corporate environment. And once we went through and we cleaned up all of the U.S. corporations from being bloated and excessively staffed. We then started to go out and look for additional ways to keep earnings growing at 10%. And what we discovered was we could then go out and start importing goods from overseas at lower costs. And this also built on the Reagan push for free trade. Even though Ronald Reagan didn't sign NAFTA, Bill Clinton signed NAFTA. The push towards free trade started under Ronald Reagan. In addition to that, Ronald Reagan did something very interesting as well. He fired the air traffic controllers. And firing the air traffic controllers basically began a process where people began to realize for the first time since World War II that you could push back against unions. Prior to Ronald Reagan firing the air traffic controllers, government workers were not allowed, and still are not allowed to strike against the government. But in the period under Lyndon Johnson and his predecessors until Ronald Reagan, you saw upwards of 15 government strikes by their employees against the government. And each one was met by a decision to raise the wages and give in to the unions. Post the air traffic controllers being fired, this dynamic began to change. Why again? Corporations had to get mean and lean in order to drive that double-digit return, in order to drive earnings up by double-digit basis. Companies had to get mean and lean. They had to control their costs. The biggest variable they have is their labor cost. And the net result is we've seen this dramatic transition. If you look at that inflation rate in that past that 1980 recession, that 1981 recession, we've seen inflation dampen dramatically. And in fact, if you look in all the business cycles past 1990, inflation really hasn't been an issue. It's never really moved above the Fed's target of 2%. Why? Because that transition to changing the dynamics of the labor market, making the labor market less union-oriented, to controlling costs, to expanding the integration of the global economy, we have seen business cycles transit where inflation no longer dominates the business cycle. But what is interesting, past 1990, if you notice, we saw credit cycles become much more volatile. And this is the important point. Prior to 1990, you can see the relative level of debt to GDP in the United States, the credit environment, just continued to grow along trend. Post 1990, we can see that credit cycles, the credit has become much more volatile. It dips down during business cycles, it rises up during expansions, and dips back down during business cycles. We've literally transited from inflation cycles to credit cycles. And to drive home this point even more, there's a unique difference in the behavior of business cycles between those pre-1990 and those post-1990. Look at all the recessions we experienced in that pre-1990 environment. We've had 12 business cycles, including the one we're in the post-war business cycle environment. 8 of them happened prior to 1990. Look at how short those cycles were, how concentrated they were in the first half of that graph. You have continuous cycles of upward movements in capacity relative to underlying capacity. You've had a big acceleration in inflation. You've had a new business cycle. It then drops down rather rapidly, the excess capacity being used. It then goes through another cyclical bounce very, very quickly. And see how quickly the cyclical declines are reversed prior to 1990. Look in the period after 1990. The business cycles have stretched out. Not only the business cycles stretched out, even though they've gotten deeper, they haven't gotten much deeper on average. What we've seen is the recovery pattern has become much more slow. It takes longer for economies to recover in the post-war period after 1990. And we're going to get into a discussion of why that's the case. And the answer is primarily because in this environment in post-1990, we've moved into a world of excess supply. So if inflation isn't driving the business cycle and credit begins to drive the business cycle, what does that really imply? That implies that something's holding down inflation. And what's holding down inflation is the fact that we've transited from a world of excess demand to a world of excess supply. You can see this pretty significantly or pretty easily by looking at our current account deficit numbers. And you can see in the period before China joined the World Trade Organization, specifically, we were running continuous current account deficits. And in the period post-China joining the World Trade Organization, we're running continuous current account surpluses. Now, a lot of economists would sit there and say, yeah, these numbers are all marginal noise at the end because of the accounting differences. All that may be true, but it doesn't account for the fact that we saw the sign shift dramatically from deficits to surpluses on sustainable basis. And the reason why that's happened is because of the growth in global trade. Look at the uptick in global trade that has taken place since China joined the World Trade Organization. And it's not just in the world. It's not just in the developed economies. It's in the emerging economies. Global trade has accelerated dramatically. And this is created in an environment in which if inflation isn't driving business cycles, credit is now driving business cycles. What happens when something goes wrong with credit? When something goes wrong with credit, something breaks. And when something breaks in the economy, it takes time for it to be repaired. And that's the critical issue we're going to discuss going forward. What breaks? And if you look at the next slide, what we're also going to add on top of this all is the fact that we don't believe the global economy is capable of getting back up to above trend growth on a sustainable basis because of the gross level of debt that's been accumulated in the economy. Every economy, once you hit 250% debt to GDP, by the way we've calculated it here, you begin to see the economy runs into an inability to grow above trend. The first economy to hit this was Japan. And notice, no matter what Japan has done since 1990, since it hit the wall, Japan has increased its debt level to GDP from 250% to 375% debt to GDP. The Japanese economy has not been able to solve its deflationary biases. If you look, it's interesting, since then, every global economy, every major region has moved into that 250% debt to GDP area. The United States, Europe, the United Kingdom, and in particular, China. This is important because the next discussion I'm going to give you about the credit story lives on the basis that we can't get above potential GDP. And if we can't get above potential GDP on a sustainable basis, then the world of excess supply tends to dominate. And if the world of excess supply tends to dominate, it explains why the Federal Reserve deliberately chose in August at the Jackson Hole meeting to announce a major transition in monetary policy back towards Keynesian economic theory. Why? Because the Federal Reserve has suddenly recognized the fact that inflation is no longer their primary concern, it's deflation. And if deflation is their primary concern, they can shift their emphasis from their dual target from being controlling inflation to achieve maximum employment to emphasizing maximum employment to finally get inflation back towards its target. And that's critical. It also drives home another point, which is why fiscal policy has no longer become effective. If you look at the multiplier that fiscal policy in the United States used to be able to garner towards economic growth relative to the multiplier we're seeing now, where basically it's 1 for 1. You give me $1 trillion of stimulus, fine, I'll give you $1 trillion uptick in output. I'm not going to give you a multiple of that. That's a critical change in the economy, and it supports the Fed's transition. In addition to these factors going on, the shift from excess demand to excess supply, the level of debt that's been accumulated in the economy, the dampening effect that that has had on fiscal policy, we're also in an environment where everybody is aging. And even though this is the dependency ratio in the United States, those people who are over 65 and over relative to the rest of the population, and you can see where it's expected to trend to go by the demographic changes in the United States, this is happening at a more rapid rate throughout most of the countries in the world, even in China. China is aging even more quickly than the United States. And as you age, you tend to see lower demand coming through. So as you see lower demand coming through in an environment where we've created excess supply, and in an environment where we've all accumulated too much debt to the point where we can't get above excess capacity, or we can't get back to full capacity, we're creating an environment of increased deflationary concerns. And that is a major problem when credit now drives business cycles. Because when a business cycle matures and runs into problems since 1990, it runs into problems for credit purposes. If you look at the chart that I've just identified on the screen, it gets to these credit business cycles that we've experienced since 1990. The first credit cycle that we've experienced since 1990 was the one that occurred back in 1990, which everyone would say was the destruction of the thrift industry. The high short-term interest rate environment, the inverted yield curve created by Chairman Volcker and the Federal Reserve in order to wring inflation out of the economy while the economy was in the process of transiting from excess demand to excess supply, created an environment that had destroyed the thrift industry. Thrifts basically lend long by borrowing short. And in an inverted yield curve economy, it basically turned their dynamics, their economics upside down. And the net result of this basically was we had a very, very deep economic recession in the 1990s. But more importantly, this was also a recession that included commercial real estate. So the banking industry got damaged by this. And in fact, it was commercial paper, real estate-related commercial paper issued by financial institutions that suffered the most in the 1990 business cycle. And as you can see, banks took a long time. Their balance sheets deteriorated. Their non-performing loans spiked up. It took a long time for those non-performing loans to drop back to a level banks were comfortable with. And if you look at the green line, which is their coverage ratio, which are reserves against non-performing loans, it took a long time for banks to get back up to a level of coverage ratio, a level of reserves against non-performing loans that they were willing to begin aggressively making new loans. And that lengthened the 1990 business cycle to where it became the longest business cycle upturn of the post-war period. The next crisis that we saw in terms of credit was what? Some people would say, if you look at the calendar, it's in that 2000, 2001 period. Oh, it was the dot-com bubble bursting. Wrong. It wasn't the dot-com bubble bursting. You know what it was all about? Enron, Calpine, WorldCom, Tyco. It was the destruction of the commercial paper industry. It was the fact that we were building merchant power energy businesses on short-term commercial paper. And what happens when you get too leveraged on short-term interest rates, on short-term funding, and interest rates go up? You get caught in a funding mismatch. And when you get caught in a funding mismatch, what happens? You're forced to restructure. And all these companies were forced to restructure. And we had that recession. Again, notice that recession took down the performing balances for banks. Their non-performing loans were driving upwards. They had to reduce their non-performing loan balances. And notice also their coverage ratio was at a very, very low level. They had to raise their coverage ratio as well in this environment. So what we're seeing here is this was the reason why the next business cycle transited, because we needed to restructure corporate America. The reason why that recession wasn't as deep or as powerful as the 1990 or what would become the Great Recession in 2007 is because this was a corporate restructuring. And the financial markets restructured corporate debt aggressively. And I'll show you that in a minute and how that plays into the dynamics. If you then look at the latest business cycle, the 2007, this was an interesting business cycle because this was not only just one balance sheet involved. This was several balance sheets involved. It was the speculative real estate boom in the United States economy. The bubble burst. And when the speculative real estate bubble burst in the United States, it took down the household balance sheet and the banking industry's balance sheet. And look at how high those non-performing loan balances spiked. And look at how long it took for those non-performing loan balances to drop. And look at the delay in the process for banks to get their coverage ratios back to a level they were comfortable with before they began lending again. So the banking industry right now, as we entered this recession, The important point to understand is we entered this particular recession, the COVID-19 recession, with banks basically being in a healthy position. Non-performing loan balances were aggressive, incredibly low levels, and still are. And their coverage ratio is 200% of their non-performing loan balances. This is a very, very healthy position for banks to be in going into a recession from a credit perspective. Now let's look at credit more specifically. We're going to skip through to the corporate sector for time purposes. I'll just go back for a minute there and just show you those other ones and highlight what they were. Basically, this next series of charts show you that basically banks have been in a position where their loan to deposit ratios have been declining, even though they were making a lot of loans. But also, more importantly, their bank capital ratios are at very, very high levels. Even at this stage, 9 months into this new downturn, we're still seeing an environment in which bank capital is very, very healthy. So the banking industry is still healthy. So then we're going to talk about the other major balance sheets we need to talk about, and those are basically the non-financial balance, corporate balance sheet, and the household balance sheet. And we're going to address the non-financial corporate balance sheet as well. And these balance sheets, interestingly enough, these two balance sheets are modeled exactly the same way. If you look at the behavior of spreads, you can see that the difference in spreads between all three of these business cycles reflect the changing nature of the economy. The 2001 spike in spread was limited because companies were restructured quickly. The financial crisis, we saw a major widening out of spreads that took a good period of time to be dampened, in particular for the emerging, high yield space, because this is what was damaged the most in the high yield space was basically the housing industry, which was damaged because of the bubble bursting, and a lot of the high yield space was involved in housing. So it took a long time for housing spreads to come back down. Notice in the current environment how quickly spreads spiked and how quickly spreads have come back down. And the reason why this is happening is because even though corporate America has loaded up on a lot of BBB debt, the interesting thing about the BBB debt that corporate America is loaded up on is if you look on this screen, you can see it's all in the investment grade space. It's all long duration debt. Where in the high yield space, it's been shorter duration debt. And this is important because when you're looking at balance sheets, what are the three major sins of leverage? The three major sins of leverage are excess leverage, borrowing short, and paying a heck of a lot of money to borrow that debt. If you're paying a lot of money to borrow debt and you're having to roll it over all the time and you got a heck of a lot of bad debt on your balance sheet, somebody's eventually going to look at you and say, you're a bad credit, I'm not lending to you. And when they do that, what happens? You're forced to restructure. And when you're forced to restructure, restructuring doesn't happen immediately. It takes time. And this is the reason why credit cycles are shallower than inflation cycles. And it's also different because we live in a world of excess supply versus a world of excess demand. And we live in a world of high levels of debt, where the ability of the economy to get back to above potential growth is dramatically limited. Now, if we look at corporate America, we can see that as a result of the COVID-19 recession, we've seen a spike in net debt to sales, which means basically they've levered. And they've levered up more than they were levered in any other business cycle, which is typically the result. Every business cycle, we go to a higher and higher degree of leverage. But the degree of leverage is only one of the sins of leverage. The other sin of leverage is the duration structure. And as you can see from the green line that I've laid out here for you, and the blue line in terms of corporate liquid assets, you can see two interesting things have happened. Corporations borrowed a heck of a lot of money. They started to shorten their duration dramatically under the COVID-19 environment, which made sense. They all had to draw down on their lines of credit because they were uncertain in the lockout down environment what would be their cash flows. They grabbed that borrowing that they could. And the net result is they're now in the process, you can see in that green line, of reaccumulating now that they have all this excess leverage and the excess liquidity and the economies are reopening, and they're restructuring their debt into longer dated duration debt. But more importantly, look at how low the corporate debt service burden still is. We're looking at multi-generational lows. We're looking at the non-financial corporate debt burden back in 1970s levels. That's exceptionally powerful. So they're restructuring their debt long, which is good, and they're paying very little to roll it over. They don't have the three sins of leverage that reduces liquidity to the non-financial corporate sector. If you look at the household balance sheet, we can look at a number of things exactly the same way. This is the level of household liability leverage. You know, it's household net debt to their income. Basically, if you look at the household sector, they're still deleveraging. Deleveraging into a business cycle recession. And you look at what we did is we took the old trend line and moved it up to the, the environment in which securitization reached its peak, which was the level where we thought banks would be comfortable providing liquidity. Households are still reducing their leverage 9 months into a credit cycle, which is telling you that household balance sheets are actually improving. Households are actually also lengthening their duration structure. This is their share of short-term debt as a result of their overall debt liability. They're lengthening their duration structure, and more importantly, their debt service burdens are declining. Households are looking at debt levels, debt servicing burdens we haven't seen since the early 1980s. These are very, very critical conditions. They're showing you this is the reason why we don't see default rates rising in all these product categories. It also shows you that we're in an environment where basically the U.S. economy is back to a situation where we can sit here today and be comfortable with the idea that the U.S. economy is fundamentally healthy. And not only is the U.S. economy fundamentally healthy from a credit perspective in a recession period, we also have an environment in here in which the U.S. is now back to an environment in which we will be able to grow out of this cycle because the Federal Reserve has finally recognized that they have to support fiscal policy decisions when the world is now facing excess supply. And they're helping by targeting maximum sustainable employment. They're going to allow this economy to keep on growing, which will allow the economy to get back to its potential. But more important, because the U.S. economy is also in an environment where we still have positive inflation against Japan's deflation, Europe's probable deflation, and China's quite likely deflation, 38% of the global economy either in or approaching deflation, while the U.S. is still running a credible monetary policy targeted towards achieving a 2% inflation rate, the U.S. dollar will continue to devalue. And as the U.S. dollar continues to devalue, it will help immunize the U.S. economy from that global excess supply situation and allow monetary policy to work its magic to drive the U.S. economy back up into a sustainable recovery. And even though a lot of people are talking in this environment about a double dip environment and things of that nature, and they're looking at the things like the payroll employment number that came out 2 Fridays ago or the JOLTS number that came out the other day, and they're looking at this data and saying all this data is telling you that we have an economy that's not producing employment, it's wrong. We're producing a very solid level of employment. In April, we had 18 million people on temporary layoffs. As of September, we had 4.5 million. And 1.5 million people went back out of temporary layoff in the month of September. That's a dramatic improvement in the labor market. And it's happening because balance sheets are strong. Why are balance sheets strong? Balance sheets are strong because banks were ring-fenced by the Federal Reserve. You saw that in the bank balance sheet. Their non-performing loan balances are high. Their coverage ratios are high. You saw corporate America. Corporate America has been able to restructure their short-term debt liabilities into longer-term debt, and they have low debt servicing costs. Households have actually been continuing to deleverage, and they're lengthening their duration and driving down their debt burden, which means even though there are clear negatives in this business cycle relating to the leisure industry, restaurants, travel, hotels, airlines, there are liquidity factors that are finding their way into other parts of the economy and restructuring the economy, which is why the recovery will be uneven, because it takes time to restructure those portions of the economy that have hit dramatically by this shock. And for these portions of the economy, it is credible, it is consistent with a credit shock, because these portions of the economy have been hit, their revenues have been hit the most. And they, therefore, are over-leveraged, and they need to be restructured. and they will be restructured over time. But the rest of the economy is enjoying the liquidity that's being provided, and we are finding other avenues of the economy to make up for those avenues of the economy that are hit by the shock. So this is the recovery. This recovery will be very consistent with a credit recovery environment, because the COVID-19 recession created a credit shock in the leisure-related industries. The net result of my analysis is basically it's no longer business inflationary cycles, it's credit cycles, which means you can no longer look at the traditional measures to figure out when an expansion is going, recession is going to come to, when an expansion is going to come to an end and when a recession is going to come to a bottom. You have to look at the credit portion of the economy. And if the credit portion of the economy is healthy, the economy can turn on a dime. And that's exactly what we believe is happening here in the transition from Q2 to Q3, and that's exactly what's being reflected in all the nowcasters talking about the fact that we could have as much as 35% rebound in GDP on a compounded annualized basis in the third quarter of this year from the 33% decline we saw in the second quarter. That's the story. I'll be glad to take any questions at this moment.
Thank you very much, Stephen. I mean, I guess as an economist myself, your presentation really resonated with me, a lot of it. So we got a number of questions even before the presentation, so I'll just kick off with them.
Sure.
So I guess on the first few slides, you talked about inflation. So I guess let's talk more about that. So everyone knows governments are printing money left, right, and center. You know, you've got massive amounts of borrowing, and obviously borrowing is super cheap right now. What do you think that will sort of do for inflationary pressures? I mean, should we be worried about that? And generally speaking, what do you think would be the outlook for inflation, say, over the next 6 months to 2 years, potentially?
Well, I think if we go back to one of the important slides that we laid out in terms of the current account surplus, showing you what's happened on a global basis, basically we're saving more than we're investing. And the reason why we're doing that is because we are in a world of excess supply. So to the extent that central banks are monetizing debt, in a world of excess supply, the inflation consequence of what they're doing is dramatically dampened. But in the United States, where we are the reserve currency, and where we've luckily had a service industry that has held up our inflation rate at higher levels than it has in other countries, this reduction in this monetization of the debt is going to allow us to keep ourselves in positive inflation. And that positive inflation against the global deflationary bias just leads to a weaker currency, which then further immunizes the U.S. economy, not just because there's global excess supply, but because the currency will immunize us from global deflationary pressures. I think we're finally possible to see the Fed actually get back to its target inflation. But I don't think we'll be looking at the kind of hyperinflation that this type of monetary policy or a monetization of the debt would normally imply to a lot of people, because the world lives in a world of excess supply right now. And those countries that are running at well below their capacity are going to be hard-pressed to create inflation.
Yeah, I would agree with that, definitely. Next question. So I guess you mentioned double-digit growth, and to be honest, everyone loves double-digit growth, especially myself. Now, we saw previously that central banks were raising their interest rates, and I guess that was potentially the upward trajectory, but then all of a sudden they've had to drop them now because of COVID. So what do you think that will do for, say, changes in personal investment patterns? I mean, do you think households will stay quite risk-averse because there's quite a big recession coming, or do you think they'll probably try and jump into more speculative investments? What do you think about that?
Well, I think you're asking a great question. I think what you're seeing is really a transition from asset preference. I think what you're seeing happen in the United States right now, after going through the longest expansion in history, where we did not have a cyclical bounce in housing, we have basically probably a 15-year backlog in necessary investment in housing in the United States. So I think what you're going to see happen is the cyclical rebound in housing is really a transition away from financial assets back into real assets. Because when the housing bubble burst, everyone moved from physical assets to financial assets, and now we're going to see a migration back to physical assets, in particular housing.
Okay, definitely, yeah. And that was very much a feature, I guess, of the massive bubble which happened 10 years ago in real estate, definitely.
Correct.
So another question here. We've seen trends toward nationalism as globalization hasn't benefited everyone. How would a strong trend toward nationalism in the USA and Europe affect your outlook?
You know, there is no doubt that nationalism has started to rear its ugly head in many, many ways. But by the same token, I think people also have to understand that even in the areas where nationalism so far has been cropping up, it's more a fact of trying to level the playing field than to reverse things dynamically. You know, if you think about it, there are regions of the world where rare earth metals are produced aggressively, right? And I'm using that simply because it's an important issue. But rare earth metals are also very highly polluting to create. Everybody has rare earth metals. Just one area of the country seems to be willing to pollute more aggressively and without cost than another in order to create rare earth metals. So the question is, are we there really on a fair footing? And these are the kind of questions that I think are being asked. So I don't think it's really a drive to nationalism as much as to a recognition that we have to somehow or another find a way to have fair trade as opposed to just free trade, especially when barriers to entry fell on one side but not necessarily on the other. So where there's a lot of demonizing of people for the concept of, oh, we're restructuring NAFTA, we're restructuring free trade deals, I think there's some fundamental merit to it. And I think what happened in terms of the world shifting to a world of excess supply shows you, and you look at how big that shift has become from the slide that's still up on your screen, it's telling you that we've gone too far and the pendulum has to swing back somewhat.
Yeah, definitely. And I guess that very much conveniently leads on to another question, which is very much about trade. I mean, still have the ongoing trade tariff wars between China and the USA. You know, you've got Brexit coming up and all the potential trade issues arising from a no deal. I guess, you know, in your opinion, do you believe that world trade will continue to be a key driver of global economic growth? Or do you think that growth will be driven more at the local or national level?
It's interesting that you said that. We've had Trump in the White House for going on 3+ years. You know, we'll see what happens, whether he's still in the White House after June. Look at what's happened to world trade growth. Right? Yeah, we've reached the peak. We reached that peak well before Trump was in the White House, but we haven't collapsed really, have we? No, world trade is still very, very important. You look at the nature of the Chinese recovery in here. The Chinese recovery is a function of the fact of reopening in other parts of the world, leading to a demand for production of goods that are still taking place in China. So for all the rhetoric, all the push towards nationalism, the net impact has not been substantial yet. And again, going back to a measure of how much there is room to get things right, we have a long way to go.
Yeah. Okay. Next question. What will be the impact of 27 trillion in debt and the Fed with 7 trillion on its balance sheet?
What will be the impact for the Federal Reserve?
Yeah.
Well, the reality is I think the Federal Reserve is going to permanently own all this debt. I think you have to understand this is a one-time transfer to the private sector of the economy from the financial sector of the economy driven by the Federal Reserve. The Federal Reserve will not unwind this debt. It will eventually mature off, but more likely just be rolled over and rolled over and rolled over. And part of the reason for that is during that whole period where the Federal Reserve from 1990 through basically this August, the Federal Reserve was in this concept that they had to normalize things. And somehow or another, they had to get growth in the balance sheet down. And for about 15 years, the Federal Reserve really didn't let its balance sheet grow at all. And yet the U.S. economy was growing. And the balance sheet fell short of where it should have been. So part of this explosion in debt and part of the Fed's taking it on is just a reflection of the fact that they had underexpanded its balance sheet to keep it consistent with the economy over time. And two, when you go all the way back to look at the level of debt that's accumulated in the overall economy relative to its trend, look at where we are. Yeah, we've had a big spike up in the latest period, but, we're not terribly far off that line of trend debt. A lot of that explosion in debt was to bring us from below trend line to above the trend line.
Yeah.
So this is the catch-up. So, the balance sheet is going to remain large. It's going to remain large because it needs to remain large.
Yeah. And I guess given that interest rates are really quite low right now, I guess that you could almost quite say that that's a very sustainable solution, presumably, yeah. And like you say, it will stay that way for quite a long time. I guess the next question I was going to ask
interest rates are negative in other parts of the world. I'm sorry, interest rates are negative in other parts of the world.
Yeah, yes, they are. Okay, next question. I guess this is about the US election coming up. And again, this is quite topical. I mean, do you think global growth, I guess more specifically global economic recovery, will be likely stronger underneath Donald Trump or Joe Biden, and why?
I don't think it really matters which one is in the White House, to be honest with you. And this goes directly back to the chart we laid out here with regard to the level of debt to GDP. It's going to be a long time before you can reverse these levels of debt to GDP to get back to an environment where global economies can sustainably grow above trend. This level of debt is weighing on the system. It's creating real yields. Even though we have negative rates in places, we're looking at implied real yields because of deflationary pressures that are so high that it's creating an inability for the global economy to get back to trend GDP. So, and given in an environment where in the U.S. economy, we've reached such a low multiplier from fiscal policy to the overall economic activity, I think the ability of the government to seriously influence the growth environment is limited. And I'll throw on top of it all, I believe if we went down the MMT path of a new Great Society experiment driven by a left-leaning liberal government, the bond vigilantes will come in and drive long-term rates up, drive real yields up higher again dramatically, and force the Federal Reserve, who right now is comfortable that they won't raise rates until 2023, to have to pull that in quickly in order to counterbalance that kind of excessive fiscal stimulus environment. So the answer to your question is, I think it's more of a market impact than it is a macroeconomic impact, the results of this election.
Yeah, definitely. And obviously, it's never really going to be clear-cut, and there's obviously always going to be impacts on financial markets and so on and so forth. Okay, that was really super insightful, and I think that's the last of our questions. Do you have anything else to add that you want to add at this stage? Anything else you might want to cover?
No, I think just in summary, I just like to say that, this business cycle, again, has characteristics of a credit cycle because we forced this restructuring on the entire leisure space. But we have still provided or allowed the economy to benefit from the continued flow of liquidity, which hadn't happened in any of the previous 3 credit cycles other than that 2000 credit cycle. And that 2000 credit cycle was the shortest of the 3 major credit cycles we have seen in this expansion, in this period since 1990. So a lot of people who are trying to draw parallels between the Great Recession and this credit environment, I think are barking up the wrong tree. It's much more like the 2000 environment.
Yeah, I would agree with that. I mean, it's a completely different set of circumstances. Banks right now have so much liquidity right now, and I guess that's effectively is going to be filtering out to the rest of the economy more than anything.
And it's being complemented by monetary. It's being accommodated by monetary liquidity as well.
Yeah, I mean, I guess from like one of my own personal questions would be, like so right now, so many things are doing funny things, and I'll give you an example: the stock market, for example. That is almost at an all-time high. You've got the Nasdaq, which is at an all-time high, for example. You've got cryptocurrency markets again, really performing well. You've got all of these asset classes doing really well, but you almost think to yourself, well, is that really in tune with the rest of the economy? Do you know what I mean? Given that unemployment may go up, we don't know. And I think that's probably a really interesting question for everyone, going forward. What does that mean? And at some point, will it all sort of fall back down to earth so unemployment is in tune with the rest of all of the other markets?
Well, if you follow the logic we laid out in terms of the liquidity and the restructuring environment that we're dealing with, what you're seeing reflected in the equity market is primarily, as you mentioned, Katie, between the Nasdaq versus the S&P, is a rotation from, the leisure type space into the technology type space, and the transitions that's taken place in terms of people's purchasing patterns and processes. And these things don't end immediately. They continue to evolve over time. And I think what you're seeing in the market is a reflection of the fact that this liquidity has allowed the economy to compensate for the illiquidity and the forced restructuring in a certain component of the economy. So when I look at the U.S. equity market, I don't see it as terribly overvalued, especially relative to earnings expectations, especially relative to earnings growth and earnings potential in the U.S. economy. So I don't think that's really the problem. I think what really you have to keep in mind is this liquidity is being provided in an environment that is smoothing the restructuring of the economy in a way we haven't seen in, 40 years, 30 years. It's amazing.
Yes, exactly. We live in interesting times, I have to say. Just while you were talking, we did get a couple more questions. So the question is, what is your expectation for interest rates over the next 3 years? Is there growth and inflation available to cause rates to move up to, say, 150 basis points?
Let me give you my targets for the next couple of months and then answer it from a fundamental standpoint. My year-end number for the 10-year note for the end of this year is 1%, 150 for the end of June next year, and 175 for the end of December 2021. Why? I believe the Fed is going to be successful in getting inflation back towards 2%. That's number one. I believe this monetary policy transition is credible. I think the Fed will do whatever it needs to do so with its balance sheet, and I think the Federal Reserve will be successful. I believe QE is a successful and constructive monetary policy tool. But in addition to that, I think this recovery is going to be sustainable. And I think a lot of what you've seen happen is a squeeze in real yields because there's uncertainty about the sustainability of this upturn. And I think as people come to the realization that this monetary policy decision is credible and that the risk of a double dip is diminished dramatically no matter what happens in the election environment, I believe there will be a natural upward push in real rates. And I believe the Fed will help that by helping driving up inflation expectations, which is the stated desire behind their current monetary policy decisions.
And final question. I'm not sure if you can answer this, but maybe you can. How much of the $5 trillion from the Fed that went into M2 went into the stock market?
Yeah, I will tell you, I wish I could figure out a way to quantitatively figure that out. I really don't know. And I really think that looking at things that way ignores the broader story of the fact that as long as the liquidity is flowing and other sectors of the economy are capable of making up the shortfall in the sectors that are hit the most, that you lose sight of what's really driving equity markets and what's really happening in terms of the economy. We've had a V-shaped recovery in retail goods spending. We've had a V-shaped recovery in housing. We are having a solid investment expenditure environment. These are all constructive things that have happened because of the liquidity, and they're what's being reflected in markets more so than just the movement in M2 growth and how that's been reflected directly in the equity market.
Yes. And I guess almost that question in a way almost hints at my suspicions around why the stock market potentially is doing so well. Do you know what I mean? So I think that is pretty much it for questions. Stephen, I have to say, I learned an absolutely amazing amount. It was an absolute pleasure for you to come and chat with us today. Your presentation was super insightful. I guess the rest of the audience really enjoyed it and gave us a flavor of things that happen and things that are likely to come. So I guess if you don't have anything else you want to share, I guess I'm pretty much going to wrap up now.
No, feel free. I think we're good.
Okay, fine. And so effectively, thank you all for listening. Thank you all for attending today's webinar. And be sure to look out for an email with the slides from today, as well as a recording. Be on the lookout for more workshops coming up to help you fully leverage all of DataStream's capabilities. And lastly, before we conclude, we really value your input and would appreciate it if you would take a moment before you leave and answer the survey on the right side of your screen with any feedback you have for us, whether it be from this webinar or the series as a whole. And finally, from all of us here at DataStream, stay safe and have a great rest of the week. Thanks for listening. Stephen, thank you very much for that. I really appreciate that. Thank you very much.
Cheers.
Cheers, pleasure. Bye.